When you look at a traditional weather forecast, there's a certain comfort in the bell curve. I mean, the meteorologist comes on screen and says there's a 90% chance of a light drizzle, maybe a 10% chance of a heavy downpour.
Right. You grab an umbrella and you feel prepared.
Exactly. You process that information, you grab your umbrella, and you feel ready for the day. You understand the boundaries of the reality you are stepping into.
Because it's predictable. The extremes do exist, obviously, but they're rare. And more importantly, they behave according to well-understood, long-established statistical rules. You don't expect a hurricane in Ohio in December.
Right, but imagine waking up, checking the forecast on your phone, and seeing something just completely terrifying. Like a 5% chance of no rain, but a 95% chance that gravity reverses and the ocean falls out of the sky.
Yeah, your umbrella is pretty much a joke at that point.
Totally useless.
Yeah.
Your standard models of reality are just fundamentally broken. And that is the exact feeling of looking at a fundamentally skewed probability distribution in today's financial markets.
It really is.
We are looking at a stack of quantitative data direct from the trading floors of May 2026 that proves institutional smart money is currently playing a master strategy called VPA. Our mission today for you, the listener, is to unpack this real-time strategy playing out right now.
Yeah, we're going to bridge a gap that usually seems impossible to cross. I mean, the gap between intense, highly speculative, pure adrenaline options trading and cold, hard, fundamental financial analysis.
We are dissecting the exact mechanics of the market as it breathes and moves right now, this week, in May 2026.
We really are.
Let's set the scene for you so you understand the macro environment. Right now, the broad consensus among analysts is that we are in a low-vol bull market. If you look at the broad market, your standard S&P 500 index funds, they are slowly, quietly trending upward without much drama.
Right. The surface of the water looks incredibly calm. Volatility across the board just seems low.
But beneath that calm surface, something wild is happening. The CQ index is currently sitting at a lofty 138.
Which presents us with just an incredible paradox. I mean, a low-vol bull market usually implies deep complacency. Everyone is relaxed, people are just letting their 401ks ride.
Sure.
But a skew index of 138 tells us a completely different, highly aggressive story. The skew index measures the perceived tail risk in the market.
Okay.
When it's that high, it tells us that massive institutional players are simultaneously buying massive amounts of tail risk protection, meaning deep insurance against a catastrophic crash, while concurrently engaging in explosive, hyper-aggressive speculation.
It's like everyone is driving 30 miles an hour in a school zone, but they're all wearing fireproof racing suits and crash helmets, just waiting for the road to turn into lava.
Yeah, that's actually a great way to put it.
And where is this explosive speculation happening? According to the data in front of us, it is hyper-concentrated in very specific sectors. We're talking semiconductors, AI compute infrastructure, and crypto proxies.
The market isn't just expecting good earnings in those sectors. The market is physically bracing for paradigm-shifting, reality-altering moves, and institutional funds are using the derivatives market, specifically options, to place highly leveraged bets on those outcomes.
Okay, let's unpack this. We're going to explore two seemingly opposite strategies today to understand how the pros navigate this. One strategy is driven by raw emotion, by the fear of missing out, and by explosive upside.
Right.
The other is driven by cold math, behavioral psychology, and institutional sluggishness. We need to start with the first major concept in our notes, the strategy driven by explosive potential, the convexity play.
Or, as quantitative analysts often call it, betting on the fat tail.
Right. What exactly are we looking at when we see a convexity play in the data?
So at its mathematical core, a convexity play involves purchasing far-dated, out-of-the-money call options that have incredibly high implied volatility. But the defining characteristic, like the fingerprint of this trade, is that the options chain exhibits a severe right skew.
Which is also known as positive skewness, right? Let's translate the mechanics of that for everyone. A call option is a contract that gives you the right, but not the obligation, to buy a specific stock at a certain price, called the strike price, in the future.
Yep.
When we say an option is out of the money, or OTM, it means the stock's current price is way below your strike price. The stock has to go up significantly just for the option to possess any intrinsic value.
And far dated just means you're buying time. You aren't looking at next week. You are buying contracts that expire 6 months, maybe a year from now.
Got it. And then there is implied volatility, or FIFO. This is essentially the price tag the market puts on uncertainty and fear.
Right. High 4 means the option is incredibly expensive because the market expects a massive amount of movement, even if it doesn't know which direction that movement will take.
Now, the absolute key to this entire phenomenon is that term, right skew. I want to spend some time here because our notes indicate this is the anomaly that breaks standard financial models.
It absolutely does.
To understand why right skew is so unusual, we first need to define what normal looks like.
In normal equity markets, say the S&P 500 on an average Tuesday, options usually have a left skew. Why is the left side of the probability curve naturally fatter?
Well, in a left skew environment, put options, which are contracts that allow you to profit when the market goes down, are systematically more expensive than call options.
Okay, why is that?
The mechanism behind this is rooted in human psychology and historical market physics. The market naturally fears a sudden violent crash. I mean, the old Wall Street adage is that stocks take the stairs up, but they take the elevator down.
Yeah, everyone panics at once.
Exactly. Because portfolio managers are desperate to protect their assets from those sudden elevator drops, market makers, the institutions that actually sell these options to the public, they know they can charge a massive premium for downside insurance.
So they hike up the price of the puts.
Right. They hike up the out-of-the-money puts, and that structural premium creates a normal left skew.
So people are willing to wildly overpay for puts just to sleep at night, knowing their portfolio won't be wiped out by a black swan event. That makes perfect sense. But right skew is the exact mirrored opposite.
It is.
Right skew is an anomaly where out of the money calls bets that the stock is going to rocket upwards becomes significantly more expensive than at-the-money options or out-of-the-money puts.
Yes. When a market heavily right skews, it tells you that the collective psychology has fundamentally shifted. The fear of crashing has been entirely replaced by an overwhelming, almost panic-induced fear of missing out.
FOMO is real.
Oh, it's intense. The market is pricing in an extreme probability of an upward explosion. People are so desperate to get exposure to a potential 300% or 400% moonshot that they are willing to drastically, irrationally overpay for those far out-of-the-money calls just to get a ticket to the show.
Wait, I have to stop you and push back here.
Yeah.
You are saying they are willingly overpaying.
Yeah.
If we're talking about buying far-dated, out-of-the-money calls where the implied volatility is already incredibly high, meaning these options are already universally recognized by every pricing model as being wildly expensive, aren't you just being the greater fool?
That's the logical question to ask.
Right. Like, if everyone knows it's expensive, aren't you just buying at the absolute top of the hype cycle? This flies in the face of basic value investing.
That is exactly the friction that makes this strategy so complex, and it requires us to fundamentally rethink how we view probability. To understand why a professional quantitative trader would willingly buy an option that their own screen says is overpriced, we have to look at the math of probability distributions.
Okay, let's look at the math.
The entire foundation of modern options pricing, most notably the famous Black-Scholes model, relies on assuming a log-normal distribution.
Which is a variation of the bell curve.
Correct. The Black-Scholes model mathematically assumes that price movements will generally clump and hover around the current price. It dictates that extreme multi-standard deviation moves become exponentially less likely the further out you go.
So the model says big moves are basically impossible.
The model literally cannot comprehend a stock tripling in a week. But when IV severely right skews, the options market is actively rejecting Black-Scholes. The market is saying, the mathematical model is wrong. This isn't a normal distribution.
They're pricing in the fat tail.
Yes, we are pricing in an extreme positive skewness, a massive fat tail on the right side of the graph.
So the market is literally predicting an anomaly that breaks the formula.
Yes. But here is the mechanism that answers your question about the greater fool. The professional convexity buyer operates on a very specific logic. If the trader has research or models suggesting that the realized skewness, meaning the actual real-world physical explosion in the stock price that is about to happen, will be even greater and more violent than the implied skewness that is currently priced into the supposedly expensive option.
Then what?
Then that option isn't expensive at all. It is actually deeply, fundamentally cheap.
Oh, I see. So if the market expects a 50% chance of a stock doubling and prices the option premium accordingly, it feels insanely expensive to an average retail investor looking at the IV percentage.
Exactly.
But if a hedge fund has alternative data suggesting there's actually an 85% chance of the stock tripling, then buying that expensive option is actually a massive value play. You aren't being the greater fool. You are betting that the market's imagination, as wild as it seems, is still too conservative.
Precisely. You are betting against the traditional mathematical boundaries. You are betting on reality being more extreme than the math.
We need to explain how this actually works in practice, because stating that a stock goes up and you make money is too simplistic.
It's much more mechanical than that.
Right, our notes dive deeply into the Greeks, the mathematical risk variables in options trading. Specifically, the data says this convexity strategy relies on two distinct mechanisms, gamma explosion and vega elasticity. I want to move away from the standard textbook analogies here. Don't tell me delta is a car's speed. Explain this in terms of market physics.
Okay, let's use the physics of gravity and astrophysics. Think of delta as your physical distance from a black hole.
I like this already.
Delta tells you how much your options price will change for every $1 move in the underlying stock. If you buy a deep out-of-the-money call, you are very far away from the black hole.
Yeah.
Your delta is initially very low, maybe 0.05.
You mean?
The stock moves $1, your options value only moves 5 cents. You feel very little gravitational pull.
It feels like you're floating in deep space, barely moving.
Right. But gamma is the exponential increase in that gravitational pull as you get closer to the event horizon. Gamma is the rate at which your delta changes.
So what happens when the stock spikes?
If the underlying stock price rapidly surges and approaches your strike price, the event horizon gamma violently kicks in. Gamma causes your delta to grow exponentially. Suddenly, the stock moves $1 and your option moves 50 cents.
Wow.
Then the stock moves another $1, and because gamma has increased your delta again, your option moves 80 cents. That is a gamma explosion. It generates a nonlinear multi-bagger return. Your profits are accelerating faster than the stock itself.
Okay, but we need to explain why that happens on the institutional side. Because gamma isn't just magic math, it's driven by actual buying and selling.
Very true.
We have to talk about delta-neutral hedging. When I, as a trader, buy a massive amount of out-of-the-money calls, who is actually selling them to me?
Usually it's a market maker, a massive institution like Citadel Securities or Susquehanna.
And they aren't taking a directional bet against me,
Yeah.
right? They aren't hoping the stock goes down.
Exactly. Market makers operate like a casino, taking a tiny fee on millions of transactions. They want to be delta neutral, meaning they don't care if the stock goes up or down.
But there's a risk.
A massive risk. When they sell you a call option, they are technically taking on that risk. If the stock explodes, they have to pay you. To neutralize that risk, the moment they sell you that call, their computer algorithms automatically buy a mathematically equivalent amount of the underlying stock.
So as the stock price rises and gets closer to my strike price, Y delta goes up, which means the market maker's risk goes up.
Yes. And because of gamma, their risk is going up exponentially. To remain delta neutral, their algorithms are forced to physically go into the open market and buy more shares of the stock to hedge their escalating risk.
Which drives the stock price up even further.
Which increases the delta again, which forces them to buy even more shares. That structural, forced buying feedback loop is the physical mechanism of a gamma squeeze. The options market literally wags the dog of the equity market.
That is fascinating. So gamma is a gravitational pull. What about vega elasticity? Our notes mention this as the second engine of the convexity play.
Vega measures how much your options price will change for every 1% change in implied volatility. Now, normally, as a stock goes up, implied volatility drops because the perceived risk is decreasing as the company proves its stability.
But we aren't in a normal market.
Right. In these extreme right skew environments, the models break and we see vega elasticity. As the stock rockets upward, the FOMO doesn't decrease, it actually compounds.
People get more greedy.
Exactly. More retail traders rush in, more funds are forced to chase performance. The implied volatility actually goes up alongside the stock price.
So you're getting paid twice. You're making money because the stock price is physically going up, triggering that gamma gravity. And you're making additional money because the options premium itself is getting fatter due to rising through V.
Exactly. It's a dual engine of profitability. When a convexity play hits, the combination of gamma forcing market makers to buy and vega inflating the premium, it hits with an astonishing violent force.
Where do we actually see this happening in the wild? Our sources point out 3 prime historical and current environments where this physics takes over.
Yeah, the first is hardcore tech and semiconductors.
Right. In our current May 2026 data, we're talking about the AI paradigm shift. Companies like NVIDIA or Supermicro. The FOMO is so intense that retail and institutional buyers alike are terrified of missing the next leg up, which drives massive OTM call buying.
The second environment is biotech. This is the clearest example of binary outcomes. Imagine a small pharmaceutical company waiting for a binary FDA approval on a revolutionary new cancer drug.
It's make or break.
The result is nonlinear by definition. If the FDA denies the drug, the company's only asset is worthless and the stock goes to zero. If they get approved, the stock goes up 500% overnight. Traditional valuation models are completely useless here.
So options price in the skew.
Exactly. The options market naturally prices in a massive right skew because the event itself is a fat tail probability.
And the third environment is the meme stocks. The Reddit-driven retail crazes we saw heavily in 2021 with GameStop and still see echoes of today.
Oh, absolutely.
When millions of retail traders coordinate to buy out-of-the-money calls on a heavily shorted stock, they weaponize that delta-neutral hedging we just talked about. They force the market makers to buy the stock, creating a gamma squeeze purely out of behavioral coordination, totally divorced from the company's fundamentals.
Yep. In all three of these environments, the traditional rules of valuation go out the window, replaced by the physics of extreme probability.
Okay, this sounds incredibly alluring. It sounds like a cheat code to unlimited wealth. But I want to inject some reality here, because this sounds dangerously like buying a lottery ticket.
Because it often is.
Let's talk about the downside, the dark side of this strategy. Our notes call this the volatility trap. We need to explain exactly how this ruins amateur traders. What happens when this goes wrong?
It goes wrong violently, and it goes wrong instantly. The primary mechanism of destruction is something called Ivy crush, or volatility crush. This is driven by a phenomenon known mathematically as skew mean reversion.
Let's break that down.
These severe right skew options are almost always tethered to a specific, highly anticipated upcoming event. An earnings report, an FDA approval, a major product announcement from Apple.
Something with a set date.
Right. The profound uncertainty surrounding the outcome of that event is what pumps the implied volatility up so high in the weeks prior. Everyone is bidding up the price of options because nobody knows what the news will be.
But then the event happens.
Yes. The very moment that event passes, the exact second the press release hits the Bloomberg terminal, the uncertainty vanishes.
The mystery is completely gone.
Yeah.
Even if the news is spectacular, it is now a known fact.
Yes. And when the mystery is gone, the IV curve violently and immediately flattens out. It reverts to its historical mean. The massive premium that was built into the options price based on fear and FOMO evaporates in a millisecond.
I want to make sure you, the listener, are visualizing this, because understanding this mechanism will save you so much money. Let's say you buy a call option right before an earnings report. The stock is at $100. You buy a $110 call, and you pay a massive $10 premium for it because the implied volatility is sitting at 120%.
Okay, setting the stage.
The company announces great earnings. They beat expectations. The stock price actually goes up 5% the next morning, opening at 105. You should be thrilled, right? You guessed the direction correctly. The company succeeded.
But you're about to lose a lot of money.
Exactly. Because the event is over, the IV instantly crashes from 120% down to its historical normal of 30%. The evaporation of that 5E premium is so incredibly severe that the value of your option drops from $10 down to $1.
It's brutal.
It completely wipes out the gains from the stock going up. Your option was essentially destroyed, even though the stock moved in your favor.
That is the ultimate tragedy of the volatility trap. You were directionally correct, but you got the volatility calculation wrong, and as a result, you suffered a near total loss of capital.
And what about theta? Theta is the Greek that measures time decay. We mentioned earlier that these convexity plays often use far-dated options, maybe 6 months to a year out.
Right.
Usually, if I buy an option that expires in a year, the daily time decay is tiny. So shouldn't that far-dated expiration protect the trader from bleeding out while they wait?
Well, in a normal low volatility environment, yes, far-dated options decay very slowly. But remember the context here. We are operating in an environment of astronomically high IV. High implied volatility physically inflates the absolute dollar price of the option contract.
So the math changes.
It does. So while the percentage of time decay might seem mathematically small because the expiration is far away, the absolute dollar value of that theta decay is absolutely brutal. You aren't losing pennies. You are bleeding hundreds or thousands of dollars every single day you hold the position while waiting for the event.
That's agonizing.
The psychological pressure of checking your brokerage app and watching that time decay eat away at your massive premium is immense.
So it's not like buying a normal ice cube. It's like buying a massive, expensive 1,000-pound block of ice, but you are storing it in a blast furnace. Even if it's huge, the ambient temperature, the IV, is so high that it is melting right before your eyes in massive puddles.
That is exactly the mechanism. To summarize the convexity play before we look at the live data, it is vital to understand that pure convexity buying is absolutely not about fundamental value investing.
You aren't looking at PE ratios.
No, you aren't looking at balance sheets or anything like that. It is a highly aggressive, high-risk bet on second-order skewness. You are betting that the entire volatility regime of the asset is going to experience a structural, permanent breakout to the upside that defies mathematical normalization.
The volatility trap makes pure convexity sound like a coin flip for adrenaline junkies. But looking at our notes, here's where it gets really interesting. The data shows us exactly how this is playing out right now.
Yeah, let's look at the numbers.
Let's take all of this theory, all this market physics, and apply it to the actual 2026 market data from our sources. We have a deep analytical stack from May 11, 2026, comparing 4 major tech players: Dell, QCon, NVDA, and DDOG.
Okay.
We need to rank them. Who has the most extreme right skew? Who has the most massive stacking of far-dated, out-of-the-money calls? Let's start with number 1 on the list.
Dell. Prel, in this May 2026 snapshot, represents what quantitative analysts are calling the lottery skew. It is the most extreme, textbook example of this phenomenon currently existing in the market.
Let's look at the specific setup. Dell's earnings report is scheduled for May 28th. The 5E rank is currently sitting at a staggering 99.04%.
That's huge.
Now, we need to clarify the difference between 5E and 5E rank because it's a common point of confusion. The overall implied volatility is 81.6%. That is the absolute number. But 5E rank tells us where that 81.6% sits relative to the past 52 weeks of trading.
Right.
An IV rank of 99.04% means that over the last roughly 250 trading days, DL's options have only been this astronomically expensive on maybe 2 or 3 specific days. It is practically at its absolute yearly ceiling.
But the real anomaly here isn't just the overall IV rank. It's the physical shape of the volatility curve across different strike prices. If you look at the far-dated options, specifically contracts expiring in December 2026 and January 2027, and you look deep out of the money at the $300 to $350 strike prices,
What does it look like?
the IV curve doesn't just slope gently upward, it is practically vertical.
It's the sheer wall of premium.
Yes, there is massive open interest, or OI, stacked at those strikes. We are talking about over 47,000 contracts sitting there for January 2027 alone. And importantly, our data set notes the microstructure of how those contracts were bought.
It wasn't slow, right?
No, this isn't passive, slow accumulation over months. This volume is driven by hyperactive at-ask buying.
Let's explain at ask. When you trade, there is a bid price, what buyers are offering, and an ask price, what sellers are demanding.
Right.
At ask buying means these institutional traders are so desperate to get into these Dell calls, they aren't even trying to negotiate or put in limit orders. They're aggressively hitting the buy button at whatever price the market maker is demanding. They just want the exposure, cost be damned.
Exactly. Furthermore, the volume put-call ratio on Durell has plummeted to 0.3.
Let's unpack the PCR deeply. The put-call ratio is exactly what it sounds like. The number of puts being traded divided by the number of calls.
Yeah.
A ratio of 1.0 means the market is perfectly neutral, 1 put for every call. A ratio of 0.3 means that for every 3 puts being bought to protect against a crash, there are 10 calls being bought to speculate on an explosion. It is heavily, dangerously skewed toward the upside. But why does that volume matter so much?
Because volume dictates the direction of the market maker hedging we discussed earlier. With a PCR of 0.3, the market makers are aggressively unbalanced. They are selling massive amounts of calls, which forces them to buy the underlying Durell stock to hedge.
Which artificially props up the stock price as we head into the May 28th earnings date.
Yeah.
So when we analyze this total data package for Dell, the 99% IV rank, the 47,000 open contracts, the at-ask buying, the 0.3 PCR, the conclusion is undeniable. The market isn't just betting on a good earnings report. A good report is already fully baked into the price.
The market is pricing in an extreme, reality-breaking fat tail event. The underlying narrative driving this is that enterprise AI server upgrades are going to result in hardware revenue numbers that completely shatter existing financial models. Dell is the perfect embodiment of an event-driven skew.
But of course, the volatility trap we detailed earlier is looming right over Dell like a guillotine.
Oh, absolutely.
If the earnings on May 28th are merely great instead of paradigm shifting, that 99% IV rank is going to collapse and it will violently crush those option buyers. It's a massive binary gamble.
It really is.
Okay, let's move away from the pure event gamble and look at the second stock in our data set, QCOM or Qualcomm. Our notes label this the momentum skew. What if the anomaly isn't waiting for a specific calendar date like DO? What if the squeeze is happening right this second?
That is exactly what the QCM data shows. QCM setup is also statistically extreme, but the timeline is compressed. The IV rank is 97.05%. The trading volume put-call ratio is an ultra-bullish 0.23, even more aggressive than DOL.
The driver's different, right?
Yeah, the underlying fundamental driver here isn't enterprise server racks, but AI phone chips and massive new component orders for Apple.
The structural anomaly here is the aggressive active buying in the $220 to $250 out-of-the-money call area. Our data highlights a very specific real-time event. The May 15th $220 call surged 169% in value in a single trading session.
That 169% single-day surge on a short-term contract indicates immense, immediate gamma squeeze pressure. Market makers were clearly caught off guard by the sheer velocity of the buying.
So they had to panic buy.
Right. As gamma expanded, they had to frantically buy the underlying QCM stock to hedge their escalating short call positions, which drove the stock price and the option premium up even faster in a vicious feedback loop.
But it's not just short-term, is it?
No, crucially, alongside that short-term immediate panic squeeze, our data also shows heavy, far-dated January 2027 call stacking. So QCM is unique because it exhibits both immediate momentum panic and long-term structural right skew.
Now let's pivot and look at the undisputed anchor of this entire market cycle, NVIDIA, NVDA. Our notes classify NVIDIA as a structural skew, but there's a fascinating caveat here. The data notes that NVIDIA's options chain is actually less explosive right now than Dell or QCM. Why is that? If it's the king of AI, shouldn't it have the most violent right skew?
What's fascinating here is that comparing Dell's metrics against NVIDIA's proves a fundamental, almost philosophical truth about options trading. The expectation of a surprise is far more mathematically expensive than the underlying asset's known, proven, long-term quality.
I love that. The expectation of a surprise costs more than actual quality. Let's look at the numbers.
NVIDIA's setup is highly instructive. Its IV rank is currently hovering around 55.58%, so it's mid to high, but it is nowhere near Dell's 99% panic levels. Its actual skew value is positive, about 0.041, meaning calls are structurally more expensive than puts.
And call volume is strong at 78.4% of total options flow.
Right. But here is the key. NVIDIA is the foundational bedrock of the entire global AI narrative. Everyone from retail traders to massive sovereign wealth funds already knows it is the dominant player.
Right. There is no secret sauce left to uncover. The market already accepts their dominance as a fundamental law of physics.
Exactly. Because it's so universally well known, NVIDIA possesses a permanent structural right skew. The market always expects it to overperform. But because that explosive upside is already universally accepted, baked-in fact, it's already fully priced into the options premium.
So there's no shock value.
There is no element of profound surprise left to cause a sudden, violent, DL-like off-fee expansion. The shock value is gone. Therefore, NVIDIA is a fantastic candidate for a long-term, slow-burn, skew-long portfolio position, but it is a terrible candidate for a short-term, explosive convexity play. The coiled spring has already sprung and normalized at a higher level.
That makes perfect sense. Finally, to complete our map of the May 2026 landscape, let's look at two companies categorized as the reversions and the rejects, DDOG and Team, Datadog and Atlassian. This shows us what happens after the explosion.
DDOG is what quantitative models classify as a post-event skew. They reported their earnings a few days ago on May 7th, and the actual stock had a massive 31% single-day pop.
Which is colossal. A 31% move for a software company of that size in one day is a massive institutional reallocation.
It is. But because the event has passed into history, the IV crush we warned about has already executed. The mystery is completely gone. The aggressive right skew that existed in DDOG's options chain before May 7th is currently flattening out as volatility reverts to its historical mean.
So what are institutions doing?
Institutions are absolutely still buying the underlying DDOG stock, but it has transitioned into a standard fundamental momentum play. The extreme, unhinged right skew phase of options speculation is over.
And what about Team Atlassian? Our notes call it a reject.
Team is excluded entirely from this speculative strategy. If you look at their options chain, it shows a standard textbook left skew.
Meaning the puts are significantly more expensive than the calls.
Right. The market is actively overpaying for puts to protect against downside risk. There is absolutely no speculative FOMO, no right skew anomaly, and no convexity setup. The market is expressing fear of the downside, not fear of missing the upside. It's a complete rejection of the AI hyper-growth narrative for that specific stock.
Okay, so we've deeply mapped the convexity landscape. We see how alluring it is, and we've walked through the complex market mechanics that drive it. But I have to bring us back to the glaring, almost fatal flaw in this entire approach.
The volatility trap.
Yes. If you buy Dell right now with a 99% IV rank, you are essentially praying for a miracle on May 28th. If the earnings are just good, the IV crush will obliterate your capital. It requires immense timing, inside knowledge, and incredible luck.
Right.
There has to be a safer, more methodical way to play these explosive tech moves.
There absolutely is. And to find it, we have to flip our perspective entirely. We have to look at the exact opposite strategy, a strategy that is not built on gambling on uncertainty before an event, but rather observing the hard mathematical reality after the event has occurred. It is a strategy called PEAD.
PEAD, Post-Earnings Announcement Drift. Let's define the mechanics of this, because our notes say this is the bedrock of institutional fundamental trading.
PEAD is one of the most robust, heavily researched, and academically documented anomalies in all of behavioral finance. It is, at its core, a fundamental momentum strategy. The central thesis of PEAD is a psychological paradox.
What's the paradox?
The market consistently and predictably underreacts to incredibly good news.
Wait, underreacts? We just spent the last half hour talking about how the market wildly overreacts, creating massive right skews and gamma squeezes. How can you say it underreacts?
It sounds totally counterintuitive, but here's the critical nuance that separates retail traders from professionals. The options market overreacts to the anticipation of news. It prices in wild possibilities. But the equity market, the actual underlying stock price, consistently underreacts to the reality of complex, fundamentally game-changing news.
Okay, that is a massive distinction.
Yeah.
So how does a professional PE quantitative trader actually identify this underreaction? What is the mathematical engine that drives the strategy?
The engine is a specific fundamental metric called SUE, Standardized Unexpected Earnings. A professional PEAD trader isn't just looking at CNBC to see if a company beat Wall Street's earnings estimates by a few cents. A 1-cent beat is statistical noise. They're looking for a company with an exceptionally high SUE.
Let's unpack the math of SUE deeply, because this is the filter that separates the winners from the losers.
SUE measures the earnings surprise not in dollars, but in standard deviations away from the historical analyst consensus. If a company normally beats earnings by 2%, and this quarter they beat it by 3%, that's nice, but it doesn't break the model. It's within one standard deviation.
Okay, so what's a high SUE?
If a company suddenly beats estimates by 40% and they simultaneously raise their forward-looking revenue guidance by 20%, that is a 3 or 4 standard deviation event. That is a massive SUE. It literally breaks the quantitative models of every major institutional fund. It means the entire trajectory of the company's future cash flow has fundamentally shifted overnight.
Okay, so let's say a company drops this incredible model-breaking earnings report. Their SUE is off the charts. The guidance is massively raised. The stock jumps 10% or 15% on that single day.
The news is out.
Right, the news is out. The market has reacted. Why does the PEAD strategy assume the stock is going to keep going up? Why is there a drift for weeks afterward? What is the exact physical mechanism and psychology causing that?
The drift is caused by a phenomenon we call institutional sluggishness, and it's governed by strict liquidity constraints. Think about a massive pension fund, a sovereign wealth fund, or a giant quantitative mutual fund. They manage tens or hundreds of billions of dollars.
Because of capital.
Exactly. When a company like DDOG or AMD suddenly changes its fundamental trajectory with a massive SUE earnings report, that big fund's internal quantitative models immediately flash green. The model signals that the fund must increase its allocation to that stock to maintain its required performance metrics.
But they can't just log into an app and buy $1 billion of stock at 9:31 a.m. when the market opens.
Exactly. This is the most important mechanical limitation in finance. If a massive fund tried to buy $1 billion in stock all at once via a market order, they would physically consume all the available sell orders in the order book. They would drive the price up so violently fast that they would completely ruin their own average entry price. Their sheer size is their biggest enemy. They're constrained by liquidity.
So what do?
They utilize execution algorithms, specifically VWAP, or volume-weighted average price algorithms. These programs are designed to buy the stock slowly, piece by piece, absorbing whatever liquidity naturally exists without causing a massive price spike. They execute thousands of tiny trades over the course of days, weeks, or even entire months.
Ah, I see. So the buying isn't over on earnings day. Earnings day is just the starting gun.
Precisely. This slow, relentless, algorithmic institutional accumulation creates a steady, persistent, 45-degree upward buying pressure on the stock. That is the physical drift. The stock price drifts upward for weeks after the initial announcement solely because big money is forced to slowly reallocate its massive portfolios to account for the new, better fundamentals.
Let me try to put this into an analogy to compare these two philosophies, the convexity play and the PED play, because they are fundamentally opposed in their approach to risk. Let's think of the convexity trader as the dreamer.
Okay, the dreamer.
The dreamer is trying to buy a lottery ticket for an explosive gamma squeeze. They don't care about the PE ratio. They don't care about cash flow. They just care about market FOMO and right skew. They want implied volatility to absolutely explode.
Yep.
But the P trader, they are the honor student. The honor student ignores the pretest hype. They wait patiently until the test is officially graded. They look at the actual SUE data, the cold, hard fundamentals. They are bidding on slow, steady, delta-driven growth based purely on mathematical reality and the mechanics of institutional order flow.
That is an excellent way to conceptualize the behavioral difference, the dreamer and the honor student. And if we connect this to the options Greeks we discussed earlier, the dreamer wants to be long Vega. They actively want implied volatility to go to the moon so their premium inflates.
Makes sense.
But the P trader, the honor student, they operate in the exact opposite way. They actually want IV to drop. They want to be short Vega.
Because they want to buy a bargain. Explain
Exactly.
that mechanism.
The P trader intentionally enters the trade after the earnings report is public. They let the event pass. When the event passes, the IV crush happens, which destroys the dreamer's position. But for the honor student, this IV crush makes the options contracts dirt cheap.
So they buy the dip in volatility.
Right. The P trader wants to buy those newly cheap options, paying almost zero premium for uncertainty, and then ride that slow, steady, algorithmic institutional drift upward. They want the safety of a low volatility, cheap entry combined with the incredibly high probability of fundamental momentum.
So we have the dreamer taking massive, uncalculated risks before the event, and the honor student playing it safe and methodical after the event. But why choose?
Now we're getting to the good stuff.
Our source notes suggest that the most elite quantitative funds don't limit themselves to one or the other. What if you could combine the fundamental safety of the honor student with the explosive upside potential of the dreamer? What if you could find a market setup that perfectly exhibits both?
And that brings us to the master strategy of this entire deep dive, the convergence of these two distinct philosophies. Quantitative funds refer to it as VPED.
Volatility-informed PED.
Yes, or sometimes called cross-asset momentum convergence. VPED is a dual filter system. It utilizes the fundamental surprise, the PED engine, the high SUE, to find the dry wood. It looks for companies that have mathematically proven their fundamental value has increased.
Yeah.
And then it utilizes the options market anomalies, the sticky right skew and the convexity signals to find the fire. You are looking for a fundamental momentum shift that is so powerful and so universally undeniable that it triggers a nonlinear gamma squeeze on top of the institutional drift.
So the overarching strategy formula, as written in our quantitative notes, is basically this. Your total profit equals the PED drift, that slow, relentless institutional buying we talked about, which drives your delta plus the gamma squeeze, which is the explosive convexity part driven by retail FOMO and market maker hedging minus time decay or theta.
Exactly. You are brilliantly using the high probability PED fundamental drift to pay for your daily time decay while you safely wait for the gamma squeeze to detonate.
Okay, this is the core of the deep dive. How does a professional smart money trader actually execute this in the real world? Our notes outline a very specific, disciplined, three-step professional workflow for VPED. Let's walk through it step by step so our listeners can understand the exact mechanics. What is step one?
Step one is the fundamental filter. This is the pure honor student phase. You run a quantitative scan on the entire market to find stocks that jump more than 10% on their actual earnings day, but price alone isn't enough.
Volume matters too.
Right. The trading volume on that day must have been 3 to 5 times higher than their 30-day average. And crucially, management must have explicitly raised their forward-looking future guidance.
Why is the strict volume requirement of 3 to 5 times normal so critical?
Because massive, overwhelming volume is the only physical proof that institutions are actually stepping in and fighting over the stock. It validates that the SUE was real and model-breaking. If a stock gaps up 10% on low volume, it's just retail traders moving illiquid shares. That is a trap.
So volume confirms institutional interest.
Massive volume proves the big algorithms have activated. This first step completely eliminates the 50-50 casino gamble of guessing before earnings. You only look at the proven, mathematically verified winners.
Okay, so you run your scan, and you have your focus list of fundamental winners. What is step 2?
Step 2 is the volatility scan. This is the dreamer phase. You take that list of fundamental winners and you look at their specific options chains. Now, as we established, normally after a stock gaps up 10% on earnings, the implied volatility crashes. The uncertainty is gone.
But what are we looking for instead?
But if you scan the chain and you find a stock where the far-dated OTM call for is sticky, meaning it stubbornly refuses to drop, or incredibly, it's actually rising despite the earnings event being over, that is a massive, glowing alarm bell for a quant trader.
What does that sticky VIV mean physically? In the market order book, why wouldn't it drop?
It means that a massive systemic short squeeze is happening and multi-layered FOMO is aggressively building. The market is looking at the SUE earnings report and the raised guidance, and the collective psychology is realizing, oh my God, we underestimated this completely. This isn't just a good quarter. This is a paradigm shift.
And the skew flips.
The volatility skewness, which might have been a normal left skew before the earnings, violently flips from left to right. The market starts pricing in a secondary post-earnings explosion.
Okay, so you found the holy grail. You have a stock with stellar, verified fundamentals and rising right skew volatility, indicating a massive incoming squeeze. You hit the buy button immediately, right?
No. And this is the most crucial, counterintuitive point in the entire deep dive. Step 3 is the microstructure entry. You absolutely do not buy on day 1 or day 2 of the breakout.
Wait, why not? The stock is rocketing, the options are screaming right skew, the fundamentals are perfect. Why would you wait and risk missing the move?
Because on day 1, the implied volatility is still too chaotic, and the price action is being driven by emotional retail traders submitting blind market orders. You are overpaying for chaos. You have to wait for what quantitative professionals call the shrinkage backtest or the volume pullback.
The shrinkage backtest. Let's explain the physical market psychology behind that for the listener.
After the initial massive spike in price and volume on earnings day, the retail traders eventually exhaust their available capital. They run out of money to buy. Simultaneously, the early buyers who got in before earnings decide to take their profits.
Makes sense. People want to cash out.
This combination naturally causes the stock to pull back a few percent, and the daily trading volume shrinks dramatically. You wait until the daily trading volume shrinks to below 30% of what it was on the initial breakout day. That volume shrinkage is the balance point.
What does the balance point tell us?
It indicates that the weak, emotional hands have sold, and the massive institutional VWAP algorithms have established their daily buying floor.
The institutions are basically saying, we will absorb all selling pressure here. We will not let it drop below this price. They are building a concrete foundation under the stock.
Exactly. That specific moment of low volume and price consolidation is when you strike. That is your entry. And at that moment, you buy far-dated, maybe 30 to 60 days out, slightly in the money or at the money calls. You specifically avoid buying the crazy out-of-the-money lotto tickets that the dreamers buy. You buy strikes that are very close to the current consolidated price.
Because you already have the PED fundamental engine working for you. You don't need to take massive, low-probability directional risk on deep OTM calls. You just get on the institutional train right as it's leaving the station, knowing the floor is protected by billions of dollars of algorithm buying.
Precisely. Use the shrinkage point to optimize your entry cost, minimizing your vega risk, and you ride the combined dual-engine wave of institutional fundamental drift and options-driven gamma convexity. It is surgical.
I absolutely love this. It is so incredibly methodical and devoid of emotion. Let's take this VPED scanner framework and apply it directly to the May 11th, 2026 market data in our notes.
Let's do it.
Let's imagine we ran this three-step process on the current market. Which companies light up? Let's start with the failed Ps, just to see what the filter catches and what we're trying to avoid. Our notes mention PLTR and SHIP, Palantir and Shopify. They both had big earnings reports recently. Why did they fail the scan?
Both PLTR and SHIP actually beat their top-line revenue and bottom-line EPS estimates. If you just read the CNBC headlines, they look like winners. But if you ran the SUE metrics and looked at the details, their forward-looking guidance was soft, and margin contraction fears grew among institutional analysts during the earnings calls.
They failed the fundamental honest student test.
Exactly. As a result, instead of exhibiting that beautiful 45-degree institutional drift-up, Palantir dropped 5.7% post-earnings, and Shopify dropped a massive 8.7%. The PED engine completely failed to ignite because the fundamental institutional buying wasn't there.
So options buyers got crushed.
If you had blindly bought their options just because of a headline revenue beat, you would have been crushed by both the stock dropping and the IV crash.
Okay, so the filter successfully eliminates those traps. Now let's look at a stock that passed the fundamental filter with flying colors. ARM Holdings. The quantitative notes call this the core double resonance. Let's walk through it.
ARM is a fantastic real-time example of VPED in action. First, let's look at step 1, the PED engine. They beat earnings massively on May 6th. The SUE was huge. As a result, the stock is up 45% in a single month. The volume dictates that institutions are relentlessly accumulating the stock.
Okay, so the fundamental dry wood is there. What about step 2, the convexity volatility scan? Did it find the fire?
It passed beautifully. Usually, after a stock runs 45%, the implied volatility completely collapses because the move is perceived to be over. But for ARM, the IV didn't crush. It stayed incredibly sticky, hovering around 72%.
Wow.
Furthermore, if you look at the options chain for the far-dated December 2026 and January 2027 contracts, the 200-plus strikes possess a severe escalating right skew.
So the market is looking at ARM's current fundamental data, and they aren't satisfied. They are pricing in exponential, unmodeled future growth. They fundamentally believe the AI royalty model ARM uses is going to create a compounding revenue explosion over the next year that isn't fully captured in the current 100-plus stock price yet.
Exactly. It possesses double resonance, a strong, verified fundamental drift, and a sticky, right-skewed options market actively betting on a further gamma squeeze.
Now let's move to the absolute textbook candidate in our entire 2026 data stack. The stock where the VPED setup is flawlessly aligned. AMD, Advanced Micro Devices.
AMD is the mathematically perfect VPED setup as of May 11th. Let's run it rigidly through the 3 steps. Step 1, the PED engine. AMD completely smashed their earnings on May 5th, resulting in an immediate 15% gap up in the stock price on massive volume. SUE is verified.
And step 3, the microstructure entry. The notes show that right now, mid-May, the stock is consolidating. It is digesting that massive 15% move and hovering peacefully around $355. The daily volume is shrinking rapidly. It is finding that institutional VWAP floor we discussed.
And then we look at step 2, the convexity fuel. The overall macro skew index is high at 135.42. But more specifically to AMD, there is a massive open interest actively stacking for the June 18th and July 23rd options contracts. Specifically, quantitative funds are aggressively accumulating the $400 strike calls. The open interest put-call ratio is a very low, very bullish 0.36.
Why those specific July 23rd dates? Why is the volume concentrated there?
Because the options market is terrified of missing out on a very specific upcoming catalyst, the Advancing AI 2026 event scheduled for July 23rd. The institutional consensus believes AMD is going to announce hardware or partnerships that physically bridge the fundamental gap with NVIDIA, and they are buying massive convexity to front-run that event before it happens.
Now, I have a major pushback here, and I want to get into the weeds on risk management. Our notes explicitly show that AMD's IV rank is currently 65%. Yes, that's not DL's absurd 99%, but 65% is still pretty expensive in historical terms. If we are executing step 3 and entering during this quiet consolidation phase, aren't we still fundamentally paying too much for the Vega, the volatility premium? We are sitting here in May. The event isn't until July. We have 2 months of brutal theta time decay to survive. Wouldn't a call spread make infinitely more sense here to mitigate that theta bleed while we wait for July?
That is an incredibly astute adjustment, and it highlights how a highly professional quantitative desk actually executes the VPED strategy versus a retail trader. You are absolutely right about the Vega and theta risk. To solve this, a professional would use a call spread.
How does that work exactly?
A call spread involves buying a call option close to the current price, say the $360 strike,
Yeah.
but simultaneously selling a call option further out of the money, say the $400 strike.
So you cap your maximum upside. If AMD goes to 500, you only make money up to 400. But the cash you receive from selling that $400 option actively subsidizes the cost of the $360 option you bought.
Exactly. It fundamentally alters the physics of the trade. By utilizing a call spread on AMD right now, you drastically neutralize your vega risk, meaning if implied volatility suddenly drops, your short option gains value, protecting you. And you significantly lower your theta, your daily absolute dollar time decay, because the option you sold decays in your favor.
But you still catch the upside.
Crucially, yes, you still maintain your positive delta exposure, meaning you still profit dollar for dollar from that slow, steady, peed institutional drift upward toward 400. It is the smartest, most mathematically sound way to play a high IV fundamental setup when you are forced to wait several weeks for the catalyst.
It's all about calculated risk management and structural efficiency. Okay, let's look at one final comparison in the May 2026 VP landscape to drive this home. The cybersecurity battle.
Yeah.
PanW versus CRWD. Palo Alto Networks versus CrowdStrike.
This comparison is a masterclass in how the quantitative options market aggressively differentiates between two fundamentally strong companies in the same sector. Both of these companies have excellent P characteristics. CRWD had a phenomenal earnings report back in March, and the SUV was strong. It's drifting up beautifully on institutional volume, up 15% in just a week as it approaches its next earnings report on June 3rd.
But the volatility scanner reveals the structural difference between the two.
Yes. CRWD's 4V rank is 61%, but the vital metric, the skew, is neutral to left. The market is acting entirely rationally. Institutions love the stock, they are buying the underlying shares, but they are also responsibly buying normal put protection to hedge their bets. It is a standard, healthy delta momentum play. It completely lacks extreme gamma convexity.
Now contrast that entirely with PanW. Palo Alto Networks completely recovered from a massive dip in February, largely because the CEO personally stepped in and bought a massive amount of shares on the open market, signaling ultimate confidence. They recently dropped earnings and gapped up 14.8%, trading near $207.
And here is the violent structural difference. PanW's IV rank is elevated at 87.44%, but more importantly, its options chain has completely flipped to a positive right skew ahead of their upcoming June 2nd earnings. Our quantitative data shows heavy, aggressive, institutional stacking of far-dated calls in the $250 to $300 range.
So the institutional market is looking at both cybersecurity companies and saying, we confidently believe CrowdStrike will do well, but we think Palo Alto might fundamentally explode and break the models.
Precisely. If you are a VP trader specifically looking for that combined dual engine of fundamental drift and gamma squeeze potential, PanW offers a much more explosive right-skewed setup than CRWD right now, despite both having objectively good fundamentals.
Okay, let's zoom out from the specific tickers. Executing this VP8 strategy, specifically the immense discipline required in Step 3 waiting patiently for the volume to shrink, resisting the overwhelming urge to hit buy on the day of the huge earnings pop when CNBC is screaming about it. It requires fighting every natural human instinct. It requires you to ignore the headline hype and wait for the dust to settle in the order book.
It does. It requires behavioral mastery. And that discipline, that ability to delay gratification and wait for mathematical confirmation, is the defining characteristic of what we call smart money.
We use that term a lot in financial media, smart money. But who are they really? Are they just isolated geniuses sitting in Manhattan penthouses with magical crystal balls?
Not at all. Smart money isn't psychic, and they don't have magical intuition. They are large bureaucratic institutions. They're global pension funds, university endowment funds, and massive quantitative trading shops like Renaissance Technologies or Two Sigma. They aren't magical.
They just have a lot of capital.
Exactly, and as we discussed earlier, their biggest operational weakness is their sheer size. Their massive capital forces them to act in highly predictable, rigid ways. They physically cannot hide their footprints in the market. When a pension fund needs to move $1 billion into AMD because the SUE model demanded it, they create massive supply and demand structural changes in the Level 2 order book. VP'd is simply a quantitative method for visually tracking those massive footprints in the data.
Let's summarize the behavioral divergence here between the retail amateur and the institutional professional, because it's the core lesson.
A retail amateur sees a screaming headline, AMD smashes earnings.
Huh.
They immediately experience FOMO. They pull out their phone and buy in the very first minute of the market opening, right at the absolute top of the gap up. They pay the absolute highest price for the stock and the absolute highest implied volatility for the option.
And then the inevitable mechanics take over. The IV crush hits them instantly. The early institutional buyers take their profits. The stock naturally pulls back 3 or 4% over the next week during the shrinkage phase. The retail trader watches their portfolio bleed, they panic sell at a loss, and they log off convinced the entire market is rigged against them.
Exactly. It's a tragic cycle. Now look at the smart money behavior. The quant fund's algorithm sees the exact same SUE, the exact same unexpected earnings beat, and the exact same guidance raise. The algorithm mathematically confirms the fundamental shift. But they don't buy on minute one.
They wait.
They wait. They patiently let the emotional retail traders exhaust themselves. Then, they spend the next 2 to 4 weeks slowly and methodically accumulating the stock via VWAP algorithms.
They step in exactly at that shrinkage balance point we talked about, right when the retail trader is panic selling in despair.
Yes, they literally buy the liquidity provided by the panicking retail trader. It is a transfer of wealth from the impatient to the patient. And at the exact same time, specialized volatility desks within those massive institutions are buying up far-dated, out-of-the-money calls to corner the options market.
Which creates the squeeze.
Right. This massive call buying forces market makers to continuously buy the underlying stock to hedge their own books, which creates the gamma squeeze right on top of the fundamental drift.
If we connect this to the bigger picture, VP isn't about gambling on news headlines or trying to predict the future. It's about using raw price and volume data, combined with the anomaly of IZ skew, to literally map the heavy, unavoidable footprints of massive institutions. You are making sure you only commit your capital and ride the wave after the big players have already locked the doors to the downside. You are essentially surfing on the wake of their massive capital ships.
You are utilizing the physical limitations of massive capital to your distinct advantage. It is the ultimate refined synthesis of fundamental value analysis and technical market microstructure analysis.
Let's recap this incredible journey for you, our listener, so you walk away with actionable intelligence. We started by looking at the terrifying, gravity-defying anomaly of right skew in the options market. We saw how pure convexity plays are thrilling, adrenaline-fueled bets, but they're almost always volatility traps.
Like the current precarious setup in Dedel, where buyers are paying literal lottery ticket premiums, hoping for a mathematical miracle on May 28th.
And we aggressively contrasted that gamble with the slow, steady, highly disciplined institutional drift of the PED strategy, the patient honor student versus the reckless dreamer.
Right.
But the ultimate takeaway here, the real alpha in this deep dive, is that staring at a massively high implied volatility isn't always a warning sign to run away. Sometimes when that high IV right skew is combined with hard, verifiable fundamental P data like we are seeing right now mapped out in AMD and PanW, it's not a trap at all. It is the exact necessary fuel for an explosive, institutionally backed upward squeeze.
It is the distinct difference between a random, chaotic explosion and a highly engineered, controlled demolition. VPED is the engineered, quantitative approach to safely capturing extreme market moves.
This deep dive gave you the exact 3 tools to navigate this. First, SUE, standardized unexpected earnings, to mathematically verify the fundamental shift. Second, PHI skew, to verify the options market's expectation of nonlinear convexity. And third, volume shrinkage, to verify the exact optimal risk-adjusted entry point.
Those 3 are key.
These 3 tools combined allow you to separate the real structural multi-month opportunities from the pure fleeting gambling traps.
It entirely empowers you to view the market not as a random casino of headlines, but as a complex, highly structured system of order flow, liquidity constraints, and institutional physics.
So what does this all mean for the future of finance?
This raises an important question, perhaps the most profound structural question of this entire market cycle. We are looking at a market in May 2026 that is increasingly systematically accepting a permanent right skew for AI infrastructure stocks. The traditional Black-Scholes mathematical model fundamentally assumes a normal bell curve world.
Yeah.
But if the collective global market structurally believes that NVIDIA, AMD, and ARM are going to constantly, relentlessly generate extreme positive surprises that break the boundaries of historical data, are we just witnessing a temporary multi-year FOMO bubble that will eventually pop? Or has the artificial intelligence revolution fundamentally and permanently broken the traditional Black-Scholes pricing model for good? Have we permanently entered an era where right skew is simply the new normal physics of the market?
That is the exact thought we want to leave you with today. If the gravity in the financial weather forecast really has reversed, your old historical umbrella isn't going to save you from the storm. You need new mathematical models, new behavioral strategies, and a deep structural understanding of the unseen institutional forces driving the market. Keep digging into your own quantitative research, keep ruthlessly questioning the established models, and stay curious. Thanks for joining us on this deep dive.